2.0 webcast series. For those of you who attended one of the earlier webcasts, it's an honor to have you back again. We closed our last webcast with remarks on what is still missing and what to expect in the near future. At this moment, we're still missing the commentary on the Globe Rules that came out in December last year. Our latest intel is that the publication of the commentary is slightly delayed, but should come at the end of this month or early March. So today, no detail yet on the content of the commentary. We will do this in our next session in March. Today, we would like to focus on specific practical examples on how we think the Globe Rules should work. And there are some interesting, almost counterintuitive conclusions we can draw from the examples. Furthermore, there is a US and EU update and an interview with the Heineken tax team. It's very interesting to hear how they assess the impact on the proposed rules and what their main concerns are. Given that we have limited time and a lot of key developments to cover, we would like to ask you that if you have any questions to include them in the chat box. Should we not be able to answer your question during today's session, we will reach out to you by email afterwards. This worked out well the last time, so please do not hesitate to include your questions in the chat box. Let's get started. My name is Robert van der Jacht. I'm a tax partner in the Netherlands and chairman of KPMG's EU Tax Center. Today, I will be co-hosting this webcast together with my colleague Arun Rambadjan, who is also a tax partner in the Netherlands and head of the international tax in EMA for KPMG. Arun, over to you.
Yeah, thank you, Robert. Thanks for the intro, and it feels great to be here again. For those of you who are attending our digital webcast series for the first time, we have been talking about various developments in light of Pillar 1 and 2 during our previous webcast, and today we'd like to further guide you through the intricacies of the new rules. To help us cover several topics, we have our trusted team of panelists for today. On the slide, you'll see Marcus Hayland. He's a managing director in KPMG's Washington National Tax and a frequent speaker to OECD developments and US tax legislation. Next to him, Vino Kalu, KPMG's EMA regional tax policy leader and former European Commission official. And this time we have also called in a number of our specialists to discuss some practical examples with you. We have Jan Moret, a tax director and an expert in tax accounting. We have Fred van Horsen, a tax partner in our Dutch practice and part of our Tax Knowledge Center. And we have Lieke Mutsaars, a senior manager in our Dutch tax practice and an expert in Pillar 2. Before we get started, there are some administrative items. First of all, this course is eligible for 1.5 PE hours. If you take part in the webcast, you can register this time with the NOB. Although, again, we would like to do that for you, we cannot. And you should do that yourself at the website of the NOB. Second, please note that we are recording this webcast and all participants will be on a listen-only mode.
Yeah, now that we've covered the administrative side, let's quickly start. In this webcast, we will focus on the latest developments on Pillar 2. We do want to, however, also flag a development on Pillar 1. For Amount A of Pillar 1, the inclusive framework is launching a set of public consultations that will occur in stages, so-called building blocks. On February 4th, the first building block was released. It is called the Draft Rules for Nexus and Revenue Sourcing, and the consultation is open until tomorrow. For Amount B of Pillar 1, a public consultation document is expected to be issued mid-2022. We intend to go in more detail on Pillar 1 in one of our next webcasts. So back to Pillar 2. During our last webcast, we discussed the challenging political landscape in both the US and the EU and whether we will see Pillar 2 happening in the near future. Marcus and Vino shared their insights on the US and the EU perspective. And we ended the section with asking Vino and Marcus where they would put their euros and dollars on. Over to you, Arun.
Yeah, Robert, let's go to the slide. So, Marcus, first to you. Robert just mentioned that the commentary is delayed by a couple of weeks. Where do we stand from a OECD perspective? Any expected changes on the timeline that is now on screen? Any more delays?
So I think the headline here is that it remains envisioned that the income inclusion rule and the subject to tax rule would be implemented and effective by 2023. That was the timeline that has been agreed for a while now, and the OECD seems to be sticking to that at least for the time being. But it is true that if you look at everything that has been released up until now. So the model rules were initially intended to be released in September, October. They were released in late December. The commentary was initially scheduled to be released in late January, and now we're in mid-February, and it hasn't been released. So you can start to see this timeline is very challenging and ambitious. And so it will certainly be a challenge to get the income inclusion rule effective in 2023. But as of now, and what the OECD is saying publicly is it remains the goal to have the income inclusion rule effective by 2023.
And Vino, where do we stand from a European perspective? In the newspapers, it is said that a number of EU member states are pushing back on the very ambitious timeline. Do you think that this timeline may change?
Yeah, Robert, thanks for the question. We ended the session in January with the conclusion that there were three big groups in the EU Council, where we have around 20 member states that are fully in favor of the timeline of the EU Pillar 2 directive. But we have 4, 5, 6 member states that have serious concerns and have stated that they need more time for domestic constitutional constraints that they have in the timing of legislation. And what we see is that group is hardening their position. The French presidency of the EU Council currently is pushing hard for a 15 March 2022 political adoption of the Pillar 2 directive, but it might not lead to the result that the French are looking for. So I expect 15th of March, perhaps a partial political consensus on certain elements of the proposal, but some elements will still have to be open, including the timeline. And that is even set aside the concern of 3 EU member states that want to link Pillar 2 to effective Pillar 1 implementation that we will discuss on the next slide. Robert.
Arun, over to you.
Yeah, let's go to the
updates.
Yeah, let's go to the next slide. So the policy update. Vino, Marcus, last time we discussed some different scenarios that Vino indicated were possible. So before I go to Vino, a couple of questions for you, Marcus. Can you take us through some of the topics that the US may address to create a better fit with Pillar 2?
Yes, it has always been understood that since the U.S. came into the discussions and negotiations on Pillar 2 already with a regime called GILTI, that the United States would not be implementing the income inclusion rule or the undertax payment rule. Instead, the U.S. would make the conforming changes to its rules in order to align the GILTI rules and the BEAT rules with the agreement on Pillar 2. And in particular, there's a few key areas of alignment. So first, GILTI as it operates today allows for high taxes to be blended with low taxes on an aggregate basis, whereas Pillar 2 is country by country. So that is one essential change to the GILTI rules that the U.S. would need to make to come in line with Pillar 2. The other key part of it is the rate. So applying on a jurisdictional basis with a minimum rate of at least 15%. And then the third key change that the U.S. would need to make is to BEAT. There would need to be a high tax exception to effectively turn it off in instances that the income is already being picked up under a income inclusion rule. All three of those changes generally are in a version of a bill that has went to Congress. It passed the House. It is coupled with, it's not just a tax bill. It's part of a much broader spending and tax bill. It has passed the House, but then went to the Senate in December and was sort of ran into some political challenges, and it still remains unclear whether that bill will in fact pass.
So Marcus, last time you indicated that the State of the Union on March 1st is something like a soft political deadline. Is that still the case?
Yeah, I mean, initially the thinking was, that speaking historically, in order for the bill to pass, many experts in this area were saying it needed to pass by the end of last year. And the reason for that is this year, 2022, is an election year. It's a midterm elections, and it's expected to be a highly contested election. And generally, big bills such as this, spending and tax, would need to be passed before that election season starts. And so, of course, that didn't happen. And so now what was then the expectation is if a deal is to emerge, an agreement in Congress is to emerge, it would likely need to happen in, say, late January, early February. Of course, that we've now gone past that deadline. And then, as you said, Arun, it was then the president's State of the Union address on March 1st, which then became the new soft political deadline for an agreement to be reached. It now seems, where we stand today, it seems unlikely that there's going to be a breakthrough on the Build Back Better Act by then. And it now seems very likely that the negotiations will carry on into the late spring and even into the summer. So it does seem that we're going to be in this period of uncertainty for several more months with respect to whether the United States will make these conforming changes to GILTI and BEAT in order to align itself with the agreement under Pillar 2.
But so Marcus, any prediction? I know you're a tax professional just like me, so we're not really good in predictions, but any prediction?
I think if you look at it from, just a logical standpoint, the United States would seem to have a strong interest in making these conforming changes because the consequences, we'll get into this as we go, but the consequences of GILTI being treated as a non-compliant income inclusion rule, which is very much the circumstance that we would be in if those three changes I mentioned are not made. That's not a very good scenario for U.S.-based companies. There's some real risk of overtaxation and a lot of administrative burden as well. So it would seem that the United States would want to make these changes, and we know the administration is clearly behind making these changes. They're right there with Germany and France and pushing this forward. But the problem is here in the United States, that clearly it needs to go through Congress, and they have different priorities and are looking at this in different ways. So it is very difficult to make a prediction. But I think looking at it logically, I would like to say ultimately the U.S. will be able to make these changes. But there's a lot of political forces at play that call that into question, not least of which is the fact it's an election year and the Democrats are starting to run out of time.
But so Marcus, but is Congress fully aware that it could turn out to be very negative if they don't comply? Or
I think they are starting to be aware. I mean, there's been a lot of press and attention, since say, when it first became clear that they didn't have the vote, the Democrats didn't have the votes in the Senate to pass the bill. There started to be a lot more attention on this scenario where GILTI would be treated as a non-compliant regime. And there's been a number of letters and articles written over the last, say, month or so that have really put a spotlight on the consequences of, the U.S. not making these conforming changes. And so if, staff members in Congress were not aware of the consequences of that previously, then I think given the attention that has been put on this over the last few weeks and months, then I think they would be aware now.
Okay, thanks, Marcus. You seem positive, but also very realistic. So, Vino, now to you. We discussed last time, we discussed some scenarios with you. Maybe you can take us through the scenarios and take us to the most likely one you think will occur.
Yeah, listening to the update of Marcus, I think the working assumption of the EU institutions is still scenario one, that the US will be able to make the amendments and therefore can qualify as an equivalent foreign IIR. Currently in the EU Directive, there is this option and this paragraph where you can rank certain countries as a qualifying IIR, which leads to basically fully included US in the globe countries that we will see later on. Scenario two is the potential option that if the US is not able to make these amendments, that well, perhaps US guilty as is could be qualified as a CFC type rule that could be covered under covered taxes per constituent entity if you have an EU CFC of a US multinational company. The only problem here is that it would require an amending of the directive, and then we need to discuss the methodology, because you would go from the worldwide blending, as Marcus indicated, at a lower rate to something that looks like a per jurisdiction approach. So that would require time and I would say technical complexity in its solution. And then to scenario three, as I mentioned before, we have 3 EU member states that clearly state they want a legal safeguard that Pillar 1 is effectively implemented. So Poland, Hungary, Estonia, and they continue to make that point. And that could potentially jeopardize EU Pillar 2 consensus. And then it would theoretically leave only the option for unilateral Pillar 2 actions by, for example, the large EU member states like Germany, France, Italy, and Spain that were pushing on this topic. And to me, the most likely scenario is scenario 4, that let's assume a failure of Pillar 1 implementation, not only in the US, but therefore also globally, could lead to potential outcome that we would have an EU digital levy that would not run foul on US trade rules, and thereby possibly saving Pillar 2. And I think that's what some of the EU officials are working on, that the Pillar 2 consensus could lead to the EU bloc and possibly Canada, Japan, Korea, Australia, UK, Switzerland, and India joining the group. So I think that's where we are currently, Arun.
And Vino, I'm wondering, since Marcus told us that the US is not taking serious steps at this moment yet, what are the actual steps that the EU is taking now?
We just were informed that the European Commission is currently drafting scenario papers that they want to discuss with some of the larger member states in the EU Council. They are taking the possibility that the US might not be able to make the amendments before, for example, the summer, or not at all. They now start to take it serious. So the working assumption of scenario 1 is slightly changing to scenario 2. And now they are gauging the interest of individual member states if they're willing to look for a wording in the directive to make, for example, US guilty qualifying as a CFC for the taxes to be taken into account. And again, this is very early stages, because you can imagine that the moment the Commission starts to investigate that route, that France will not be able to get a political agreement on 15th of March. So the French presidency wants to push forward without complicating matters too much at present.
Okay, Marcus, Vino, thank you for sharing your insights and thoughts. And to me, it's clear we're not there yet, not in the EU and not in the US. But on the other hand, we do see a number of countries announcing the introduction of domestic top-up taxes, expectedly all with a view of not having another country collecting the tax under the globe rules, as the UK government openly outlined in their consultation note. So since our last webcast, we've seen, for example, Montenegro and the United Arab Emirates joining the ranks of these countries. So there's more to come in the coming months, starting with the commentary and then the consultation on the implementation framework, which should provide more insights into Pillar 2 and the implementation within the EU and possibly, as we hear from Marcus, also in the US. So if we now go to the differences between the GLOBE rules and let's say the EU directive. Fino, we spent some time on that last time. Can you explain once more what are the major differences in the GLOBE rules if you compare them to the EU directive?
Yes, Arun. As I mentioned before, the clear indication of the Commission is they want to follow the OECD model rules as closely as they can. And under item 1, we know that the commentary is coming up soon from the OECD, and we've been made aware that in the opening recitals of the EU directive, there will be a phrase claiming that for the interpretation of the Pillar 2 rules under EU law, guidance should be taken from the OECD commentary. So it's a clear indication they want to stick as close as they can to the OECD rules. However, under item 2, there is the issue of the freedom of establishment, because you cannot treat a cross-border group less beneficial than a domestic group. And therefore, certain amendments have been suggested by the Commission, and most notably, the extension of the GLOBE rules to purely domestic groups, basically adding on to an IIR that also would apply if the ultimate parent entity jurisdiction has a low text ultimate parent entity in its scope. We will come to that example at the next slide. Under item 3 here, what is interesting is that the Commission, between brackets, has placed under foreign income inclusion equivalency that it should be a 15% rate and only on a jurisdictional blending, which means that at the current drafting of the directive, the US guilty as is, as currently stands, does not fulfill that test. And I think that's a notable element currently. Under item 4, we've highlighted here that there's also a penalty of 5% of turnover for non-compliance. And this element we flag here because we have received questions. What happens if US cannot be counted as a GLOBE country because guilty is not in conformity? How would EU member states then calculate, let's say, the jurisdictional ETR of non-EU subs of a US multinational? How would they get that information? But if you read the directive closely, the constituent entity in Europe is supposed to file a GLOBE information return. And if you do not comply to those information rules, this penalty of 5% kicks in. So there is a clear EU solution for situations that the US is not considered a GLOBE country.
Okay, and I think you have an example on that, right? If we go to the next one.
Yeah, Arun, just a minute on, let's say, the differences between the OECD GLOBE rules and the EU directive, right? So on the left-hand side, we see a basic case where we have a US ultimate parent entity. This is a situation that the US is in full compliance with the GLOBE rules and therefore can be considered a GLOBE country. And all the other countries that are part of this graphic, where we have a Dutch intermediate and operating companies in country C. And purple means high text and blue means low text. So it means that at the level of the US ultimate parent, we'll have the IIR application picking up the low text in country C, so from company 2 and company 3. And the under tax payment rule, the backstop rule will apply for the part where the US ultimate parent entity is considered low tax. And then based on the allocation key, the top-up tax will be divided between all the participating countries in this graph. If we go to the right-hand side of the slide, we see the specific EU context where the Dutch BV company is also considered low tax compared to the US example on the left. And therefore, the income inclusion rule will also cover the low tax part of the Dutch ultimate parent entity. So that's one of the differences in the outcome. Arun?
Yep. And then I think we have another one, Vino.
Yeah, we have here another base case of the situation that the US cannot be considered a globe country. So US guilty is not amended, and therefore the globe rules will only start to apply from the level of the Dutch intermediate and the operating companies below in country C. So we only have the Netherlands and country C that are considered globe countries, and therefore the low tax subsidiaries, company 2 and company 3, the pickup of the top-up tax will be at the level of the Dutch BV entity under the income inclusion rule. And as far as there's a low tax parent company in the US that is not a globe country, the undertax payment rule will kick in for the Netherlands and country C, again based on the allocation key insofar that the US company is considered low tax. And on the right-hand side, we come to the same conclusion as the previous slide.
Yeah, I think this raises interesting questions on how the US will deal with other countries applying the income inclusion rule and the undertax payment rule, and how guilty is considered by the other countries if the US itself would not apply the globe rules. Thanks, Vino, for sharing these examples. And I think what we later in this session with Marcus, we will discuss this in some more detail. Robert, let's go to the Dutch view.
Yeah, thanks, Arun. Well, at the end of January, the Dutch government published a so-called cabinet appreciation on the proposed EU directive, the so-called BNC fiche, which stands for in Dutch beoordeling nieuwe commissievoorstellen. The Dutch government fully supports the BEPS 2.0 project. I think that is the main conclusion that we can draw from this appreciation. In line with various motions made by a number of members of the Dutch Parliament, they will make every effort to ensure that the negotiations for the directive are indeed successful. After the ECOFIN meeting on January 18, it became clear that some countries would like to see both pillars becoming effective at the same time. In other words, they see Pillar 1 and Pillar 2 as one package. The Dutch government is not one of these countries. The Dutch government would in principle be willing to agree on the EU Pillar 2 proposal independently of the progress on Pillar 1. After having read the cabinet appreciation, there are a number of observations I would like to make. First, the Dutch government notes that the EU directive leaves it up to the member states to decide how the globe rules are implemented in domestic legislation. And this leaves room to embed the globe rules in the current Dutch Corporate Income Tax Act, but also to consider a separate tax law. The concept of Pillar 2 is considered not to fit from a conceptual perspective in the current Dutch Corporate Income Tax Act. And this would make it more difficult to embed Pillar 2 in the current set of rules. It would also add significant complexity in the execution of these rules by the Dutch tax authorities. This becomes also clear in the cabinet appreciation with the reflection of the Dutch tax authorities on the proposed EU directive. They consider it as very challenging. For the implementation no later than January 1st next year, it is noted that it is important that the impact on the IT infrastructure should be limited as much as possible. The Dutch government has for that reason suggested to implement Pillar 2 as a separate tax law. In other words, the Pillar 2 rules will not be incorporated in the existing Corporate Income Tax Act. And this raises actually all sorts of different questions. Could it be implemented as a self-assessment tax, whereby the taxpayers themselves calculate and pay the tax, like we already see, for example, for VAT and wage or payroll tax? And how does a separate tax law interact with existing double tax treaties concluded by the Netherlands? Will this be a cover tax? And if it's not, can the taxation under the GLOBE rules be effectuated under double tax treaties? And can the tax imposed under the Dutch GLOBE rules be credited at the level of the UPE if that UPE jurisdiction has not or not yet implemented Pillar 2? And this question is obviously very relevant if the US were not to adopt Pillar 2 immediately. An alternative approach to a separate tax law suggested by the Dutch Association of Tax Advisors, the NOB, is creating a separate Pillar 2 box within the Dutch Corporate Income Tax Act. And this could solve the issue of the interaction with double tax treaties that I've just flagged. Another thing which stands out to me is that the Dutch government does not address the possibility to introduce a domestic top-up tax. With the Dutch statutory corporate income tax rate of 25.8%, it is expected that most taxpayers are taxed at a higher rate than 15%. This surprises me a little bit. On the basis what we've seen so far, the interplay between the rules to determine your GLOBE income and adjusted cover taxes versus the rules to determine your taxable income and tax due could lead to unexpected outcomes and ETRs below 15%, where you would not expect this from the outset. At this stage, no reference is made to launching a public consultation similar to what the UK and Finland have done. So they've already launched a publication, but no plans in the Netherlands. The Dutch Parliament has indicated that it would like to be continuously updated on any relevant developments and that no commitments are made without prior consultation of the Parliament. And this becomes also clear from the 12 pages of questions raised yesterday by members of the Dutch Parliament. So hopefully in a next phase, a public consultation will be launched whereby the various questions can be addressed. Finally, I would like to mention that the Cabinet appreciation makes it clear that the Dutch government expects 3,000 MNEs to become subject to the Pillar 2 rules. And this number of 3,000 includes both UPEs based in the Netherlands as well as subsidiaries in the Netherlands where the UPE is resident elsewhere.
And Robert, is there something in there that says something about the potential impact on the companies that are in scope of the GLOBE rules?
Yeah, well, I mean, according to the Cabinet appreciation, there will be an increase of a regulatory burden for the in-scope companies. And yes, I know this is stating the obvious. So last week, I went to Heineken in Amsterdam, where I spoke and talked with Mark Meltzer and Albert Harthold of the Heineken Tax team to discuss what their views are on Pillar 2. So let's have a look at this interview. Yeah, so that was nice to visit the office of Heineken. I saw
Quick question, Robert. Did you get a goodie bag?
no.
No?
No.
Too bad. Go on.
Sorry. I saw in the chat box that a few people had some technical issues with the sound. Please leave a message if there are more people that experience the same issue. To make us aware of that, because that's something that we need to look into, because we're planning in our next session to do another interview. So please post the message if you have experienced technical issues. Yeah. So getting back to the video, when listening to both Mark and Albert, yeah, it is so obvious that when your ETR is above 15%, that an exemption would help tremendously to reduce the administrative burden. So Marcus, what do we and what can we expect from the OECD on this point? Do we expect any changes in the rules at the OECD level? A safe harbor, less adjustments required to your globe income, or a more wide application of the jurisdictional consolidation?
So they have in the rules that were released in December, the model rules, there's a placeholder in chapter 8, which is on the administration, for safe harbors in 8.2 and then administrative guidance in 8.3. So they've punted on this question for the time being because the focus has been on finalizing the substantive rules themselves, and then their thought is we'll then having finalized the rules, then pursue the simplification measures as part of the implementation of the rules. This question of simplification has been a big focus area for the OECD since the very beginning of this project. If you go back to the public consultations that were held in, say, 2020, this was by far and away the most common comment from the business community is try to simplify these rules, either through a whitelist or maybe through a CBC-based ETR test. And so this has been something that the OECD has been studying for a very long time. The trouble with it is, I think in certain individual companies, it may be obvious that your rate is above 15, but it's difficult to make that determination for every company in every circumstance. So for example, if you look at the US, I mean, we have a 21% rate with state about 25. And so I think you could look at that and say, well, that's an obvious case of a country where you're always going to be above 15. But there's a number of circumstances through FDII deductions, through R&E credits, through low-income housing credits, and a number of other provisions where, if your circumstances are such, it actually can take you below 15. Or if you look at a country like France with a patent box regime. So it is very difficult to reach that determination in every case and in every circumstance that the income in that jurisdiction is below 15. That's been what the OECD has been struggling with, and that's why the whitelisting has been so difficult. They are definitely, as far as I'm aware, studying it very closely and trying to get there on some type of simplification, likely using CBC with less adjustments. But it is difficult to get countries to agree to the simplifications because some countries are just concerned that it undermines the integrity of the rule. So that is the balance. Importantly, there is a coming public consultation on exactly this question. At the end of, initially was thinking at the end of this month, but maybe in March or so. And so businesses will have an opportunity to provide input to the OECD on exactly this question. And I would strongly encourage everyone that is within the scope of Pillar 2 to respond to that consultation.
Thanks, Marcus. And Vino, from an EU perspective, what are the expectations on this point? I mean, we did not see any safe harbors mentioned in the EU directive. Was this done intentionally?
Yes, Robert. I don't think it was done intentionally. The EU was well aware that, for example, the commentary was not public yet. Safe harbors need to be finalized. So I think it's just a matter of waiting for the OECD results at the end of the day, where, of course, the EU is also a party to that debate. And I assume, given the opening statement in the EU directive that will be included in the recitals, that the OECD commentary and any related documentation to that will be guiding and interpreting the actual impact of the globe rules, I would assume that these safe harbors would be copied one-on-one into an EU context, leaving three main items to be open in the EU directive. That's the timing, it's the safe harbors, and it's taking into account US guilty if it's not amended.
Hey, Robert, one question to you. Back to the interview, you also discussed with Mark and Albert that the EU is considering, next to public CBCR, also to have multinationals publish their effective tax rate. So what exactly is that proposal?
Yeah, yes, Arun. The proposal to publish the effective tax rate is part of the communication on business taxation for the 21st century by the European Commission, and that was published on May 18, 2021. As part of the short-term goals to ensure greater public transparency, the proposal is made that certain large companies, so multinational companies operating in the EU, should publish their effective tax rate on a country-by-country basis.
Okay. Okay, thank you. So let's quickly go to the next one. We're now at the practical examples. So we want to give you some insights on how the rule works by a number of case study. Lieke, are you there? Can you take,
yes, I'm there.
take the globe wheel?
Yes, more than happy to take you and everyone else on a ride today together with Jan, Fred, and Marcus.
Yep.
So perfect. So what we discussed last time is that the globe rules can be divided into 5 key steps. 5-step approach, we dub it. And it starts with assessing whether an M&E is in scope of the globe rules. So once it's clear that the globe rules apply, the globe income or loss of all constituent entities will need to be determined on a per entity basis. Subsequently, the adjusted covered taxes need to be determined, again also on a per entity basis. This to be able to calculate the effective tax rate on an aggregated level per jurisdiction. And next then, the jurisdictional top-up tax in step 4. The jurisdictional top-up tax is then allocated to each constituent entity in a jurisdiction on the basis of the ratio of its globe income versus the total globe income of all constituent entities located in that jurisdiction. And as a last step, the application of the income inclusion rule and under tax payments rule comes up when there is a top-up tax. And that will need to be assessed also per jurisdiction and per constituent entity. Well, let's further look into these steps through a number of examples. First, scope. Who is in scope? Well, as said, the 5-step approach starts with determining whether the M&E group falls in scope of the rules. In this respect, an M&E group needs to be able to determine whether it is within the scope of the globe rules by assessing the consolidated group revenue. Then it will need to identify the constituent entities of the group if it's clear that you fall in scope of that revenue threshold test. And then you will need to verify which entities may be considered excluded entities. And lastly, the location of the constituent entities is also important to be able to assess how the rules should apply. Well, if an entity can be qualified as an excluded entity, they're excluded from the operation of the globe rules. They're then not considered a constituent entity. This, however, doesn't mean that the revenue of these entities is not part of the consolidated revenue test. The revenue test refers to M&E group. And an M&E group refers to entities as such and not to constituent entities. So M&E groups are in scope of the globe rules if their consolidated revenue is 750 million euros or more in 2 of the 4 fiscal years immediately preceding the tested fiscal year. So when looking at the small table in the right upper hand corner of this slide, we see that this M&E group meets the consolidated revenue test for the tested year T, as in the years T-4 and T-1, more than 750 million euros of revenue is reported. Globe rules would then apply to this M&E group. Now let's look at an example where an M&E group merges with another M&E group. How would you then need to apply the consolidated revenue test? Well, in this example, 2 M&E groups have merged to form one single M&E group in T-1. Chapter 6 of the OECD Globe Rules outlines specific rules for joint ventures and also how to deal with mergers and demergers. Well, when a merger has taken place, in the 4 years prior to the tested year, being T, you're required to add the revenue of the M&E groups for each tested fiscal year together. And for the purpose of the consolidated revenue test, you then again need to assess if in at least 2 of the 4 fiscal years preceding the tested year T, you meet the revenue threshold. So applying this, we end up with meeting the revenue threshold in years T minus 3, where we have a combined turnover of 755 million, and the merger year itself, T minus 1, with a turnover of 765 million. Whereby we assume that the revenues of the disappearing M&E group are recorded on a consolidated basis at the level of the UPE in the merger year itself. So in the tested year T, the M&E group therefore meets the consolidated revenue test 2 out of the 4 years. The 750 million euro threshold are met, as a result of which the GLOBE rules apply. Well, there are many more examples we can show on the implications of these rules and how to deal, for example, with joint ventures. But in light of the available time today, we'll save these for our next webcast. So thank you, Arun.
Thank you, Lieke, for this example. Jan, when reading through the rules and comparing these with our Dutch tax principles, there are a number of surprising items you would need to consider when determining the top-up tax. What do you see in practice, Jan? Jan, you're still on mute.
Here I am. Yes, thank you, Robert. Yes, in some scenarios, you see some effects that you initially would not expect. That's also what you already highlighted. This, for example, when you have a headline rate that exceeds the 15%, but due to the mechanism of the GLOBE income and cover taxes rules, you can still get below a 15% GLOBE ETR. But also the other way, it's true, where you have a headline rate that's below 15%, then for certain situations, you are not immediately impacted by these rules. But let's take a step back and discuss how you would need to determine the GLOBE income of an entity. Financial accounting is the foundation for all these GLOBE rules. As a first step, you can take the consolidated financial statements of the ultimate parent company, and you can boil down to the standalone financial accounts of the relevant entity. This requires that the financial accounts of that specific entity are before consolidation adjustments. So in other words, it needs to include intercompany transactions and dividends. There's only one exception, as an example over here, and that's in the event of a fiscal unity where you can make an election. Rules apply that deal with inconsistency in intercompany pricing, but also where the pricing is not at arm's length, and adjustments then may be needed. Under the step 2 here on the screen, after this rather important basic step, adjustments may be needed to arrive at the GLOBE income. And let's go through some of these adjustments. Here you see the first item is a rule stating that you need to exclude dividends with the exception of short-term portfolio shareholdings. And short-term portfolio shareholding means an ownership of interest of less than 10%, which has economically been held less than 12 months after the date of distribution. And exclusions also apply to equity gain or losses. The GLOBE rules allow you to exclude, for example, your share and result of an investment. But bear in mind that this exclusion is only possible when you have an interest of at least 10%. So this rule is therefore different from the excluded dividend rule. Then you also have adjustments that are made when you have accrued pension expenses that have not been paid to a pension fund. And this may be relevant with companies having a defined benefit pension plan. Other adjustments are, for example, adjustments related to foreign currency gains and losses attributed to differences between accounting and tax functional currency. And finally, there are also some elections. For example, you have elections where you can determine the gain and losses using the realization principle for purpose of computing the GLOBE income instead of the fair value or impairment accounting. Other examples relate to stock-based compensation, and we will discuss that in an example. Step 3 are allocation rules. These rules are in place for the allocation of GLOBE income to, for example, a permanent establishment or flow-through entities. The GLOBE rules have provisions in place that allocate the GLOBE income to the relevant permanent establishment or the owners of the flow-through entity. And finally, you have some special cases where constituent entities are joining or leaving the group, or for the transfer of assets and liabilities on certain reorganizations, but also transitional rules that may have an impact on the GLOBE. Here's an example. When we look at the diagram on the left, we have a group where an LBV is the ultimate parent. And LBV has two shareholdings that are both resident in a low tax jurisdiction. And one of the entities that is resident in the low tax jurisdiction has an investment in an operating entity that is subject to 25% corporate tax. And in this example, an LBV, company D and E are being consolidated. And company C is not consolidated, as an LBV only has a minority interest of 7%. In this example, an LBV is going to divest its 7% shareholding in company C to a third party. Now, as we have mentioned before, equity gain or losses can be excluded only when there is an at least 10% interest in that entity. Now, as an LBV only has a 7% stake, any capital gain is therefore part of the globe income and cannot be excluded. As an LBV has an interest of 7%, we assume that the Dutch participation exemption rules apply to this situation. And due to this participation exemption, no current tax will be recorded for the capital gain in the Netherlands. And as under the globe rules, you are not allowed to exclude the capital gain here. This means a higher globe income, but the adjusted covered taxes remain the same. So therefore, this effectively lowers our ETR and potentially triggers top-up tax. When we look at the investment at the level of company D, we see that investment in company E is generating a net result after tax of 75. If we assume that company D has reported this in its income statement as a share in result, then for globe purposes, company D can exclude this item. And in the event company D has no other income than its result on company E, no further globe income consequence arise in this scenario. And then even when you see over here, it's a low tax jurisdiction. The same applies at the level of an LBV in relation to its investment in company D. And an LBV can fully exclude its share in the result of the company D. Now, not stated in this diagram is the impact of any potential withholding taxes. Now, there is a different attribution rule for withholding tax on dividends. And yeah, withholding tax on dividends are attributed to the constituent entity that is paying the dividends. So in case company E would have paid dividends, then this withholding tax cannot be allocated to company D as the recipient located in a low tax jurisdiction. Well, I think this is a rather surprising effect, since for accounting purposes, the withholding tax are an expense for the entity that's receiving the dividends, and that's company D. If you go to the next example, in this case study, we find another example of a potential surprising effect of the difference between a globe income and the Dutch tax rules. We have an LBV that's located in the Netherlands, and that's granted stock-based compensation to the employees. Company A, the parent of the Dutch entity, has also granted stock-based compensation to its employees. Now let's assume that for accounting purposes, both company A and the company in the Netherlands have booked expenses that relate to the grant stock-based compensation through the income statement. Then in this example, the stock-based compensation expenses in jurisdiction of company A are deductible for tax purposes. And in the Netherlands, as we all know, stock-based compensation expenses are non-deductible for tax purposes. Under the globe rules, an election can then be made to replace the amount expensed in the P&L with the amount allowed for tax purposes. And in the case of the Netherlands, it would be beneficial for an LBV to not apply this election, as otherwise the expense would need to be added back for globe income purposes. Not making the election then has a positive effect on your effective tax rate for globe purposes. Otherwise, the globe income would increase as the expenses recognized for purposes for tax are zero. An increase of the globe income without changing the covered taxes would decrease the ETR, therefore potentially resulting in top-up taxes. Now, this election is a 5-year election and must be applied consistently to the stock-based compensation of all constituent entities located in the same jurisdiction for the year in which the election is made. And for that reason, it's possible to make an election for the Netherlands and not to make the election for company A. So now we have a basic understanding of the globe income. We go to the covered taxes. And both amounts are needed in order to calculate the effective tax rate under the globe rules. the effective tax rate needs to be calculated on a jurisdictional basis. And it's equal to the sum of the adjusted cover taxes of each constituent entity located in the jurisdiction, the numerator, divided by the net global income for all constituent entities of the jurisdictions for the fiscal year, being the denominator. Now, in this section, we focus on the numerator of the ETR calculator, adjusted cover taxes. Similar to the globe income, the financial statements are the starting point for the cover taxes. First, you need to take out uncertain tax positions. You also need to remove accrued taxes that are not expected to be paid within 3 years. You will also need to exclude taxes on income that is excluded for globe purposes. And finally, in this first step, there is a specific regulation in place that is dealing with the refundable tax credits. Depending on the type of credit, this may require you to adjust the amount of cover taxes. In the second step, you need to make adjustments to the cover taxes by the total deferred tax adjustments. This is a major area in the cover taxes rules and is dealing with an approach to timing differences, but also the volatility in the ETR number due to the valuation allowance change in tax rates, as an example. And some of them will be explained via an example later on. The deferred tax adjustment approach are that you take the deferred tax expense accrued in the financial statements. The special rules are in place when the applicable tax rate exceeds the minimum globe rate. It requires you to recast the deferred tax expense for a deferred tax liability to the minimum rate of 15%. And when the deferred tax expense on the deferred tax liability is below the minimum rate, no recasting is required, which is different from the deferred tax asset on losses. Under step 3, certain allocation rules apply. These require you to allocate the globe income and related cover taxes to, for example, a permanent establishment. Similar allocation rules apply to, for example, CFC tax regimes, hybrid and transparent entities, which each of them have their own specific allocation rules. Furthermore, there are specific rules about attribution of the covered taxes to the constituent entities that may be located in different jurisdictions. And finally, certain events can trigger a requirement to recalculate the prior globe ETR.
Yeah, Jan, we're running out of time a little bit, so can you do the one for tax losses and then we'll go on? Yep.
Sure. Then let's only discuss this one and then we keep the other one for the next time.
Yep.
In this example, we have an M&A group with a Dutch BV as the ultimate parent. And now starting with company B that is located in country B with a 0 tax rate. Now assume that this company has tax losses incurred in year 1. The starting point for deferred taxes is those reflected in the financial accounts. Now since the tax rate is 0, the company did not book a DTA on those losses. The way how the globe rules are dealing with this is that they have a deferred tax asset election. And via this election, the filing constituent entity can elect to take the net globe loss for a particular jurisdiction multiplied by 15%, and that's to calculate the deferred tax assets. Now you as the loss-making company can take into account this DTA when the entity will have a globe income in the future. Thereby it's reducing a potential top-up tax in the future when it's going to be profit-making, of course. Now the election is most useful for jurisdiction with a 0 rate, but you can also use it for jurisdictions that have a corporate rate that is above the minimum rate. And if that makes sense, that requires a deeper analysis because it potentially you lose other aspects of deferred taxes, such as the entire mechanism to address temporary differences and corresponding deferred taxes. And moving to company C1, that company has also tax losses, but now with a headline rate of 10%. However, the goal of the rules is that if you book a loss in a year, that you can offset that in a subsequent year against income. The globe minimum tax rate of 50% applies in the subsequent profit-making years, but now allowing to use the DTA that was recast of 15%. And we show you in the next sheet how that might look like. Before that, we have also company C2 over here. This company has not recognized deferred tax asset on losses, better known as a valuation allowance on the US GAAP. And in this case, the company C2 has incurred losses, but the deferred tax asset was not recognized due to an underperformance or an issue with the business. They were not expecting to use that deferred tax asset on losses for offset in future years. So this is not relevant for globe rules. So you reverse any valuation allowance. And to the extent you have not recognized the deferred tax asset in the first instance, you will recognize it against 50%. Now let's go back to the numerical example of company C. In year one, company C is showing a loss of 100, for which it booked a DTA for accounting purposes of 10. But for Globe, now this is recasted to 15%. And that's where you show it here. That's a -5 additional tax benefit as you increase your DTA for Globe purposes towards 15%. And the effective tax rate therefore is 15%. In year two, the company can utilize 100 of the prior year tax losses. And due to the utilization of the losses, the recognized DTA on losses for Globe purposes of 15 will be an expense. This therefore results in a tax charge for Globe of 15 with an income of 100. So no top-up tax for year two as the ETR is 15%. In year three, no more losses remain, so the 100 profit is subject to 10% tax, resulting in an ETR of 10%. Now, this is below the minimum rate of 50% and results in additional 5 top-up tax needed. We had another example on the deferred tax liability, but in the interest of time,
let's do that next week, Jan. So let's go through slide 30 and 31, computation of ETR and top-up tax. And here we don't have an example on this, but here's where you see how the ETR is calculated, how to apply the substance-based income exclusion, and how you arrive to the final top-up tax per constituent entity. And again, we have not detailed this further in an example, but the new thing that is in here is, of course, the qualified domestic top-up tax that reduces your normal jurisdictional top-up tax. Okay, so let's go to the charging provisions, Fred. We have some template. Fred, in the example of, we saw some surprising situations in the example of Jan, which you would not expect. So do you also see that back in the charging provision?
Yeah, indeed, some of the outcomes of the charging provisions we have applied are quite surprising, especially in case there are third-party shareholders somewhere down the chain in a group structure. We will come across a couple of those situations in the next examples, but my basic takeaway is never trust your professional instinct or professional intuition when looking at a certain case, but always closely read the charging provisions when dealing with a specific case. Now, the charging provisions are all about allocating the jurisdictional top-up tax, or TUT. That is, of course, assuming that the jurisdictional top-up tax will not be absorbed by a domestic top-up tax, provided that this tax is a qualified domestic TUT. Now, in case there is jurisdictional top-up tax to be allocated, this will be charged to a parent entity through the income inclusion rule, the IIR, or as a backstop through the undertaxed payment rule, the UTPR, to one or more constituent entities of the group that is in scope. We will discuss a couple of examples to show you that indeed there is far more than meets the eye. Now, before we start, I would like to remind you that calculating the top-up tax is an algebraic exercise based on Chapter 5 we previously discussed. So in our examples, we will not calculate the TUT. The top-up tax in the examples is a given and not subject to discussion as far as I'm concerned.
Okay, so let's do the example, Fred.
Okay, sure. So in terms of facts, what do we have here? We have countries A, B, and C that all apply the globe rules. And the situation is that both country A and country C are low tax jurisdictions because the ETR in both jurisdictions is below 15%. And as a result, we will have to see how the IIR and the UTPR charging provisions will have to be applied regarding the top-up tax of 50 for country A and 200 for country C. Now, when you look at the left-hand side at the bottom of the slide, you may wonder why company C1 qualifies as a low-taxed entity since its ETR apparently is 20%. Now, this is not a mistake in the slide, but it has everything to do with the fact that we have to apply jurisdictional blending when calculating the ETR over globe income. The amount of adjusted cover tax for companies C1, C2, and C3 divided by the aggregate amount of globe income of these entities has apparently resulted in a jurisdictional ETR of country C of less than 15%. And as a result, the total amount of top-up tax for country C has been calculated at 200, and this amount of 200 first has to be divided between companies C1, C2, and C3 on the basis of their respective shares in the aggregate net globe income in country C. This division is relevant, especially in case there is more than one direct shareholder in either one of these companies, which in this case is not the case, but in other situations may be the case. As the next step, we will apply the IIR charging rules. First, we will have to start characterizing the companies in the org charts for the purposes of the IIR charging rules. Company A, ACO, is the UPE, the ultimate parent entity. Company B is an intermediate parent entity or an IPE. It is directly held by its UPE ACO, and it has an ownership interest in other constituent entities of the same group, companies C1, C2, and C3. These companies, C1, C2, C3, they are so-called constituent entities of the group, but they are not IPEs since they hold no interest in other constituent group entities. The starting point of the IIR charging provisions is that both the UPE and the IPE BECO are in scope to be subject to the IIR charging mechanism by the jurisdiction of which they are resident, and this follows from Articles 211 and 212 of the OECD model rules. However, Article 213 states that if a UPE jurisdiction will charge the IIR, then the jurisdiction of the IPE cannot charge the IIR. And as a result, in this case, country A can charge the IIR to company A, the UPE of the group, and country B cannot charge IIR to company B. The next question is, which amount of top-up tax country A can charge under the IIR mechanism to company A? On the slide, we see that both country A and country C are low tax jurisdictions. Now let's start with the 200 top-up tax of companies C1, 2, and 3. This top-up tax will be charged under the IIR mechanism by country A to company A. And we still have in our box the 50 top-up tax of company A. Under the IIR charging mechanism of the OECD Pillar 2 model rules, country A cannot charge the country A top-up tax of 50 to company A. Vino already indicated that under the proposed EU directive, this is different, as under the EU directive, country A, as jurisdiction of the UPE, can and must charge the 50 top-up tax to company A. So under the proposed EU directive, the UTPR in this case would be out of scope since the full that amount of 250 would be charged under the IIR mechanism to company A. But under the OECD Pillar 2 model rules, this is not the case. And after having applied the IIR, we should therefore move on to the UTPR to deal with the 50 top-up tax of company A. The right way to approach the UTPR is as follows. We start with the full amount of top-up tax of 250, the total top-up tax amount of countries A and C. And this follows from Article 251 of the model rules. However, based on the mechanism laid down in Article 253 of the model rules, the top-up tax of 250 is reduced with the 200 top-up tax of country C that has been charged to the UPE ACO under the IAR mechanism. And the remaining country A top-up tax of 50 is subsequently allocated to the globe countries where the MNE group has constituent entities, in this case being countries A, B, and C. And this allocation of the UTPR is made via a substance-based formula that considers the number of employees and net book value of tangible assets of the MNE in the respective globe jurisdiction relative to all employees and the total value of net book value of tangible assets in all three globe jurisdictions. If we make the calculations on the basis of Article 2.6 of the Pillar 2 model rules, we will see that the ACO's top-up tax of 50 is charged under the UTPR rules by country A for 3.75 to ACO, by country B for 10 to BECO, and by country C for 36.25 to CECO 1, 2, and 3. Now, in terms of learnings, the following can be mentioned regarding this situation. Jurisdictional blending indeed can cause an individual ETR to drop below the minimum level of 15%. And under the OECD model Pillar 2 rules, the top-up tax for the jurisdiction of which the UPE is a resident cannot be charged under the IIR, but should be charged under the UTPR mechanism.
Fred, do you want to do the POPE or the fragmented holding structure?
Whatever you want, Arun. I'm happy to do either one of them.
I'm really curious because the UPE wins from the IPE. So what happens if the UPE meets the POPE? So well, just go for the POPE.
We go for the POPE in that situation. Let's move indeed to this example where we meet a very special guest, being the POPE. In this second case, we have made a slight change in the org chart presented in the previous case study. In this case, we see that company B is partially owned by third parties for 25%. And as a result of this, company B no longer simply qualifies as an IPE. For globe purposes, it now also qualifies as a partially owned parent entity or a POPE. This has important consequences for the IIR charging provisions. In the previous case, we saw that for the IIR charging provisions, an IPE jurisdiction basically has to yield to the UPE jurisdiction, with the consequence that the IPE jurisdiction cannot charge the IIR in case the UPE jurisdiction does charge the IIR. In case of a POPE, however, this is completely different. Under the IIR charging provisions, in case of a POPE, both the UPE jurisdiction and the POPE jurisdiction can charge IIR. This follows from Article 2.1.4 of the model rules, but the UPE jurisdiction effectively has to yield to the POPE's jurisdiction as a result of the IIR offset mechanism of Article 2.3 of the model rules. It basically must grant a credit for the IIR charged by the POPE's jurisdiction. You may ask yourself the question, what is the reasoning now for the special status of the POPE under the IIR charging mechanism? Well, this special status, this pole position of the POPE all has to do with the following. If the POPE would be treated as an ordinary IPE, intermediate parent entity, that would have to yield to the UPE, the amount of the IIR that could be charged to the UPE in respect of the 200 top-up tax of CECO 1, 2, and 3 would have been 150, being 75% of 200. This follows from the IIR inclusion ratio of Article 2.2 of the OECD Pillar 2 model rules. In the case at hand, you will see that ACO holds an indirect interest of 75% in the low-tax constituent entities CECO 1, 2, and 3. However, because the POPE jurisdiction has precedence under the IIR charging provisions, country B can charge the full amount of 200 regarding the low-taxed C entities to BECO, because BECO itself holds a 100% interest in the low-taxed C entities. And as a result of the IIR offset mechanism, there is no country C top-up tax left for country A to charge under the IIR rules. So the priority rule of the Pope jurisdiction under the IIR charging mechanism has everything to do with maximizing the IIR charge. In this example, similarly to the previous example, we still have to deal with the 50 top-up tax of country A UPE, but the outcome of that under the UTPR is the same as in the previous slide, because for UTPR purposes, the Pope has no special status. So the outcome for the UTPR regarding the country A top-up tax is the same as in the previous situations. So the basic, now moving over to the basic learning of this case, beware of a Pope in the group. That's the first learning. And the second learning is be aware of the IIR inclusion ratio and the IIR offset mechanism.
Okay, thank you, Fred. Lieke, can we move to slide 36? Because I do want to ask Marcus a question. So Marcus, just we talked about a lot about the US outlook on Pillar 2, and just take like a couple of minutes and make us understand what are the US considerations if Pillar 2 is or let's say if guilty is aligned with Pillar 2 or if it's not aligned. Can you spend a couple of minutes on that?
Yeah, just briefly. This is what I'm calling scenario 1. So this would be the circumstance where guilty is treated as a compliant income inclusion rule, which would require, of course, the United States to make amendments to guilty to go country by country with a rate of at least 15%. If that happens, in this picture, you would expect that the U.S. Guilty regime, which would be applying at the level of the ultimate parent entity, which is assumed to be a U.S. entity, that would pick up the low tax income in CFC 5, which is down there in the bottom right, similar to the way that the income inclusion rule would operate. And so what that then leaves then from a Pillar 2 standpoint, guilty only applies to foreign income or controlled foreign corporations in U.S. language, but it does not apply domestically in the United States, as Vinod told us. And so the primary focus area for U.S. companies in this scenario is how would the undertax payment rule apply to the U.S. domestic profit if that income is taxed at a rate below 15%. And as I've said, there are some circumstances where that actually can be the case. If we go to 37, the next slide, please. This is then scenario 2, which is, let's assume that the guilty reforms are not made, and so guilty stays as it is. What does this look like for a U.S. company? And so here, as was outlined previously in the discussion, guilty would be treated as a non-compliant income inclusion rule, which would be the rule applying at the level of the ultimate parent entity. And therefore, you would drop down to the intermediate parent, which is the Netherlands in this case. And then the Netherlands would be applying its income inclusion rule to the income of the low tax jurisdiction, which is CFC 5. The complexity here is it's not, that doesn't quite all fit together because guilty is still applying in respect of CFC 5, and then now we have an income inclusion rule at the level of Netherlands applying to the same income simultaneously. And so there would need to be some coordination and credits provided in order to avoid double taxation. So that's really the big concern for U.S. companies right now is potentially gaps between the application of current guilty in this scenario and the application of an intermediate parent's income inclusion rule. So in a nutshell, Arun, that's kind of what it would look like under both scenarios.
Okay, thank you, Marcus. We're nearing the end of the session. So some key takeaways. What is still to come? So we discussed the latest developments and shared some insights on the ramifications of the globe rules, and we had various examples. We didn't do them all, but we will come to that next week and also show some surprising effects there. What's missing, we're waiting for the commentary to come and also the consultation on the implementation framework and maybe some insights on the safe harbor elections. There's a lot to discuss, and we're looking forward to take you through this adventure. There is an ambitious timeline. We're all looking at that 1st of January 2023 for the IIR to kick in. So that's close. So join us on March 17 for our next webcast, where we hopefully will discuss this commentary and also have more practical examples. And as a surprise guest, or no longer a surprise because I'm going to tell you now, Sebastian de Buck, the VP of Tax of Unilever, will be sharing his thoughts on Pillar 2 with you. So any final remarks, panelists, Robert, before we go?
Yeah, sure. Thanks. Yeah, I think even though the timeline, as you mentioned, is ambitious, the political pressure remains strong, and it remains to be seen how it will evolve in the coming months within both the EU and also, of course, at the US level. The political consensus will need to be converted into legislation, whereby for the Netherlands, for example, consideration is given how the Pillar 2 rules are implemented, as this may host a whole bunch of new questions on the interaction with double tax treaties. Arun.
Okay. Anyone? No. Okay, so let's then wrap up today's webcast. To those of you who raised a question, we have not been able to respond. We will get back to you via an email. If you have any questions, you could also email us. Please do not hesitate to also look at the Digital Economy Tax Tracker app for updates on some key news and legislative developments, and to get access to the KPMG member firm publications on tax issues in this digitalized space. So the app is free to download in the App Store. Again, our thanks to everyone for attending today's webcast. We will be distributing the webcast slides and playback via email shortly. In the meantime, please do not hesitate to contact us if you have any questions. Thank you and wish you all a nice evening.